Today on Inside the Issues, I speak with Jim Haley on global financial governance. Hello and welcome to this week's edition of Inside the Issues, a CIGI online podcast. I'm David Welch, the CIGI Chair of Global Security at the Balsillie School of International Affairs and Professor of Political Science at the University of Waterloo. Every week I'm very pleased to welcome into the studios here at the Centre for International Governance Innovation in Waterloo, Ontario, a distinguished guest, an expert on some aspect of global governance or international public policy. And today I'm very pleased to welcome Jim Haley, CIGI's Director of Global Economy. Welcome to the show and welcome to CIGI. You've had a distinguished career at the Department of Finance in Ottawa, and I just want our viewers or listeners to understand that your remarks today are yours rather than the Government of Canada's. Let me start, Jim, by asking you what it is that you'd like to do with the Global Economy program here at CIGI.
Well, thank you, David. It's a pleasure to be here. And I think initially in the early days of my tenure with the Global Economy program here at CIGI, I'd like to first of all understand really where we are in the global economy, where the pressure points on which CIGI can make a valuable contribution to understanding the needs for global governance. What I mean by that is to say that if you look over the last 30 or 40 years, we've had this remarkable process of integration, financial and economic integration, in other words, globalization. And that has been, there have been very serious financial and economic crises associated with that. And I guess what I would like to do is understand the underlying nature of those crises and how improvements in global governance, creation or the modification of international institutions can help ensure that the benefits of globalization or that process of integration that we've observed over, as I say, the last 30 or 40 years really do benefit people and by, in fact, reducing poverty, stimulating growth, and leading to better lives around the world.
Mm-hmm. Now, I understand that you have a particular interest in finance and also a particular interest in economic history,
right,
which a lot of people don't have because they don't teach economic history in the standard curricula as much as they used to anymore. Is it fair to say, in your sense, that global economic or economic crises in general are more common or more acute today than they have been in the past? We've always had economic crises. Is it just that they reverberate more because of globalization? Or is it because they're more serious?
I think it's a bit of both, really. I think you've seen, certainly over the last 30 years, an increasing frequency of financial crises. I mean, you can go back to Mexico, 94, 95, and the peso crisis. And of course, you had Asia, 97, 98, the Asian financial crisis. You had Russia, Argentina, a whole list of countries that experienced crises. And so I think we are seeing more frequent crises, but I think as well the magnitude or the severity of the crisis has increased. And you can think in terms of going from Mexico 94, 95 to the Asian financial crisis to the subprime crisis 2007, 2009, where really the crisis then was centered in the United States and the key core country of the global financial system, and its negative effects radiated out to the rest of the world, to the periphery, as you will, with profound consequences for the entire global financial system.
Of the crises you mentioned, I suppose some people would say some of those basically were domestic crises that went regional, went global, and others had more global causes. And I suppose in the second category, people would say the Asian financial crisis, not necessarily triggered by domestic economic situation in those Asian countries particularly. What's your sense of the balance here? Are global financial crises now largely a result of domestic economies going bad, domestic policies going bad, and the global economic system has to find a way of containing and equilibrating and compensating? Or is it the causal arrow running in the other direction? Or we set up a global economic system that is causing crises in specific parts of the world?
Well, I think let me back up to Asia, and I think it's pretty clear that there were very significant, very serious policy imbalances in many of those economies. But I guess the point I would make is that the financial system, the international financial system that we have, inflicted such an enormous cost on those countries. In other words, yes, there may have been policy imbalances, but the costs inflicted were disproportionate to those imbalances. So whereas in the past you may have had a balance of payments problem or crisis resulting in a steep decline of GDP for a quarter or two, what you saw in 97, 98 was this cascading crises from country to country. It was almost as if you saw a bank run as international capital flowed out of country after country. And so I think the point here is that that the financial system has or did contribute to the severity of these crises, in part because of the massive withdrawal of capital, the so-called hot money flows, when problems started to emerge in these economies. And so the question is, what can we do to ensure that the financial system, the global financial system, and the international institutions that we have created to help ensure countries can benefit from financial integration actually reduces both the severity of those crises and the frequency that we've seen. I think that's a major challenge, and it's one that the international community has been working on for a decade or more, certainly since the Mexican financial crisis.
Right. Well, very good. We'll talk about the governance angle in just a moment when we come back with Jim Haley. You're watching or listening to Inside the Issues, a CIGI Online podcast. Look for us at cgonline.org, on Facebook, on Twitter, and on YouTube. Welcome back. So let's talk about the international governance architecture. I guess it hasn't changed a lot, has it, since the end of World War II? The main organizations, institutions, regimes governing global financial system, more or less the same with a few modifications.
More or less the same. I mean, at the centerpiece of international financial governance is the IMF. And the IMF really is the cornerstone for all of the work on the international side. Following the Asian financial crisis, however, there was the Financial Stability Board, formerly known as the Financial Stability Forum. So there has been some innovation in recognition of the significance and the role of international capital in propagating these financial crises. But as you say, David, the architecture really hasn't changed that much, and I think that's part of the problem, that the IMF in particular is trying to deal with capital account crises with the same instruments, the same tools that it was designed, or that it had to deal with old-fashioned current account crises or balance of payments crises in the 1950s, 1960s. And I think that is part of the big challenge going forward, to recognize that the nature of these crises has changed because countries have liberalized their capital accounts. They've opened up their economies to foreign capital. But the supporting international institutions and frameworks have not evolved. They have not changed in pace with the very remarkable evolution of financial markets around the world. And so that is a major challenge.
And what's your sense of the big shortfall there? Is it that there's not enough resources in the system? In other words, if the IMF just had a lot more resources to play with, it would be able to cope with new changing circumstances relatively well? Or do we need a different structure?
It's not clear that it is just a question of resources, although there are many people that would say that we do need to expand the size of the IMF to make it a much bigger institution so that it has the capacity to deal with these financial crises. That's an argument. I think it's a valid argument, but I don't think it's just that question. There is as well an issue about getting the rules of the game for global capital. And here I would refer to domestic bankruptcy law. At the domestic or national level, we have bankruptcy laws to help deal with situations in which a firm encounters severe financial difficulty. The idea of bankruptcy law is not to necessarily to force a firm out of business, but to ensure an orderly, timely restructuring of the firm's finances And the idea there is to preserve the value of the firm. You want to preserve the value of the firm. You're not protecting any particular subset of stakeholders, but you want to try and ensure that the firm continues as a viable institution. You want to ensure that the assets of the institution can be used to produce output and create employment. I don't think there are many people that would argue about the need for domestic bankruptcy legislation. But it's clear that we don't have analogous legislation or an analogous set of legal frameworks at the international level. And I think that is a major void. And I think going back to the crises that we've seen, certainly since Mexico, Asia financial crisis, Russia, Argentina, and so on. If you look at those crises, I think you could say that they're in part the result of inadequate legal frameworks that would have allowed, or that allowed financial capital to move out very, very quickly and resulted in very steep declines in output.
So you're talking in effect as though states were analogous to firms. At the international level, states are analogous to firms at the domestic level. So we need some kind of global bankruptcy mechanism for
you don't necessarily need a global bankruptcy law. I think, and that has been used as arguably the strongest case against the notion of introducing a legal framework for bankruptcy at the sovereign or international level.
Although we're almost seeing that with Greece now, right? One way of interpreting the European response to Greece is that Greece has been forced into bankruptcy, and there's an attempt to craft an orderly restructuring.
Well, but that is being done through so-called voluntary debt exchange for private creditors.
Right.
It is not being done using the coercive power of the state to enforce an orderly, timely resolution. And I guess Greece will provide a very, very interesting test case to see just how effective a voluntary approach can be. The track record over the last decade or so has been pretty favorable. I mean, we've seen a large number of countries that have restructured their claims using primarily a voluntary approach, with one notable exception, of course, and that is Argentina.
Mm-hmm.
So this is one area in which there is still quite a bit of uncertainty, quite a bit of doubt about how the process will move forward. But I guess I'm saying it's one that we need to continue to push on to ensure, as I say, that the legal frameworks, the rules of the game for international capital markets keep pace with the very remarkable process of financial integration that we've seen over the last several decades.
Is it notable at all that the IMF has not really been centrally involved in the Greek situation?
Well, the IMF has been involved. And it is playing a role as part of the so-called Troika.
Mm-hmm. Taking a second seat to the Europeans themselves, the Germans, the French.
I think, far be it from me to speculate, but I suspect that's a very conscious decision. And
optics.
Greece is part of a currency union, and it is the first responsibility for dealing with that currency union, I think, would or should reside with the other members of the currency union. And hence, you have the European Union and the major players in the European Union and the Eurozone, namely Germany and France, playing a leading role. The IMF is there providing technical advice, technical support, and putting money on the table. But I think if the European Union and the other major players in the Eurozone weren't there, I'm not sure what exactly the role of the IMF would be.
All right. Very good. Well, we'll be back again with Jim Haley to talk about the global financial governance. You're watching or listening to Inside the Issues, a CIGI online podcast. Look for us at cgonline.org, on Facebook, on Twitter, and on YouTube. Welcome back. What have we learned from history? We had a lot of learning after the Great Depression and after World War II, which resulted in a spectacular innovation in global financial governance, the creation of the IMF, creation of the World Bank, also on the trade side, General Agreement on Tariffs and Trade. In recent crises, what have we learned from the past? Are we still, in effect, endorsing in our lesson drawing the lessons of the 1930s and the responses to them? Or are we beginning to change how we interpret the lessons of history as we used to understand them?
Well, I'm tempted to cite Mao. I think who said, it's too early to say what the lessons from the French Revolution really are. As I mentioned earlier, David, for the first several decades following the Second World War, the international financial system was marked by the so-called Bretton Woods system: fixed exchange rates, capital controls. This had the effect of allowing countries to follow demand management policies to keep employment as close to as possible the full employment level. But through the 80s, early 90s, we had a number of countries, in fact virtually all countries, remove capital account controls. And we went from having, therefore, crises in the current account to crises in the capital account. And this had the effect, or these capital account crises were much larger. So instead of current account balance of payments problems of 2 or 3% of GDP, we went to a world, in the case of the Asian financial crisis, for example, of crises of capital outflows of 10, 12, even 15% of GDP. Moreover, those crises occurred over a much shorter period of time. They didn't unfold over several quarters as the balance of payments problems in the 1960s, say, did. They occurred almost overnight. And again, it's this almost bank run-like phenomenon where investors, foreign investors, decided they had to get out of the country. They liquidated assets in the country. They went to the central bank, said, I want hard currency, I want US dollar reserves. The central bank essentially ran out of reserves and was therefore put in this incredible dilemma of either allowing the exchange rate to depreciate dramatically or raising interest rates significantly to try and preserve the value of the currency and keep money flowing in. And that really did change the nature of these crises. And so I think if you go back, and the Bretton Woods system was really based on the terrible dislocation of the economic stagnation of the 1930s. And it was, as I mentioned, intended to help governments maintain full employment.
So really this world of capital-oriented crises is new. We don't really have experience of that. That wasn't what the 1930s
Well, it's new
was
and it's
about.
old, because there was a very, very comparable situation I would argue, in the 1920s, early 1930s. It was then it was a period of a gold standard that wasn't working as people thought it would, or that the gold standard had worked prior to the First World War.
And nobody to step up and provide general financial services to the whole community.
If you compare the gold standard prior to the First World War, and you could say it was supported, defended, enforced by the Bank of England, which had, as you can imagine, enormous international credibility, backed by reserves, that if another central bank on the gold standard experienced liquidity problems, the Bank of England would be able to provide liquidity to that central bank. Of course, the gold standard was also supported by the hegemony of the United Kingdom and Her Majesty's Royal Navy. And if a country went off the path of good behavior, it was not uncommon for a gunship to enter the harbor, take over the customs house, and collect the revenues that were owing to Her Majesty's subjects. Mm-hmm. So there was a system that was enforced by both carrots and sticks. The carrot being the liquidity that the Bank of England could provide, and the sticks provided by the Royal Navy. In the interwar period, countries went back to the gold standard in an effort to recreate the discipline that was evident in the pre-World War period. But not everybody played by the same rules of the game. In contrast to the first gold standard, countries or some central banks, in effect, didn't allow gold inflows to follow through and create inflation in domestic economies. They instead sterilized the gold, and by sterilizing, pulled purchasing power out of the global economy. So as a result, you had country after country scrambling for liquidity. And as Keynes would have said at the time, in this environment, there was this mad scramble for gold, which was the golden fetter of the gold standard. Mm-hmm. So the lesson from the interwar period was that governments needed to have some policy discipline, but they also needed the flexibility to try and maintain employment. And that was as I say, that was the real lesson that Keynes drew from that experience. And it was the lesson that went into the design of the Bretton Woods system.
Right.
The IMF and the creation of the IMF.
Mm-hmm. Very good. We'll be back one more time with Jim Haley. You're watching or listening to Inside the Issues, the CIGI Online podcast. Look for us at cgonline.org, on Facebook, on Twitter, and on YouTube. Welcome back. So I have a couple of questions which I think are related.
Sure.
So I'm going to try them on you in a related way, and you can react to them any way you like. It could be that part of the problem in the current world is that capital just moves around too quickly and too easily. Mm-hmm. But on the other hand, to the extent that there's been a dogma recently about what's good for the world, it's been the Washington Consensus about opening markets and liberalizing and deregulating to some extent, and actually promoting flows of capital in and out of countries. So arguably, one of the big problems today has always been seen as a virtue of the system. Now, it may be that these crises we're seeing nowadays are just the downside of what is, on balance, actually a really good deal. Mm-hmm. That the world is much better off than it would be without this liberal Washington Consensus, and that economic growth would have been slower without it, and we all would have been poorer without it, and this is just the price we pay now. So I guess one question would be, is there plausibility to that argument? And if so, does that mean this is just the price we have to pay? In other words, if we're going to try to solve a problem of capital sloshing in and out of countries too quickly and too high volume, the price we're going to pay is lower economic growth, lower productivity.
Well, I guess, let me just stop you. And on that point, I guess there would be a number of people that say the issue is not just the level of growth, but also the volatility or the variance associated with that growth. People may be prepared to accept greater volatility if they also get a much higher rate of growth from that system. And to some extent, that's probably what we've seen. We've had some economies, for example, the so-called BRICS, Brazil, Russia, India, China, growing at a very, very rapid pace, in part because they have done they've implemented very good, very sound policy regimes in some respects, but they've also opened up their economies. So they have integrated into the global economy, and that integration has generated enormous benefits for the people of China. When you think of global poverty, think of the millions of people in China that have been lifted out of very, very severe levels of poverty.
Although China hasn't bought into floating exchange rate.
China has not bought into floating exchange rate, but they have liberalized their economy in many respects. And of course, the issue of the exchange rate liberalization is a very important one, and one in which is a subject of considerable concern in some quarters. But the point is that I think opening up the economy of China, Brazil, Russia, India has generated enormous benefits. And it has also created some volatility. And the real challenge to me, therefore, is to see if we can put in global governance institutions that will allow that growth to occur, but reduce the volatility, reduce the variance, reduce the dangers associated with, fast growth one year, recession or depression the next year. because in that environment, I worry that you start having social consensus fraying, and that feeds through to bad politics. Bad politics leads to even worse policies leads to even worse economic outcomes. So it's ensuring that people can reap the benefits of globalization without exposing them to a much higher degree of volatility in their lives.
So what global governance innovation would you flag as particularly important in recent years? Some people would point to the G20 and say, oh, the G20 is a new attempt to provide coordination at a critical mass.
Right.
But the G20 has its critics also who point to the fact that it doesn't actually have its own independent existence, its own resources. It requires upon the willing collaboration of the partners.
Right. Well, I think the G20 really came into its own in November 2008. There was the Leaders Summit in Washington in November 2008 was truly, I think, a historic event, in the sense that you had G20 countries at the precipice, looking at a very, very serious situation in terms of what was happening in financial markets and what was happening in terms of employment, output, and global trade, all of which were crashing. And in that circumstance, G20 leaders got together and agreed to avoid the mistakes of the Great Depression. And the three major mistakes, I would say, in the Great Depression were central banks that did not provide liquidity in a timely and sufficient manner, in part because of the concerns associated with running the gold standard. Second of all, fiscal policy was allowed to turn pro-cyclical. That is to say that governments seeing fiscal balances deteriorate raise taxes or cut back spending in an effort to try and maintain or return to balanced budgets. But of course, those fiscal measures actually exacerbated the downturn. So policy was pro-cyclical. It reinforced the cycle. And then the third tragic error of the 1930s was trade protectionism. You could argue that it started with the Smoot-Hawley tariff in the United States, which was quickly followed, and retaliation followed retaliation, and international trade collapsed in the 1930s because of this remarkable increase in trade barriers. And so in November,
we've solved that problem, though, haven't we? I mean, trade protectionism is not anything like the problem it used to be in the global economy.
It's certainly not the problem that it was in the 1930s, and we, over the last 50 or 60 years, the level of tariffs have been negotiated down. But I think the really important part of November 2008 was the agreement by G20 leaders to avoid pro-cyclical fiscal policy, to ensure that central banks provided liquidity when it was needed, and the standstill on trade protectionism, that they agreed not to impose protectionist trade measures in an attempt to protect employment at home by beggaring thy neighbor by raising tariffs that would have reduced employment abroad. And so that really was a truly, as I say, historic moment. The question going forward is whether that same level of cooperation can be sustained. And there are some that would say that will be very difficult to do, because we've seen a divergence in the economic situations of the major players. Whereas China and India and Brazil very quickly resumed the path of strong, return to the path of strong economic growth. Some of the more advanced economies, the United States, the United Kingdom, Eurozone countries, really have been languishing, trying to make up the output lost in the recession, and struggling under the burden of very, very high public debt. And in that environment, it has become very difficult to get an agreement on how to keep the G20 process going forward. There's an important initiative, the G20 framework for strong, sustainable, and balanced growth, and that, I think, is incredibly important. But the question is, will G20 members agree on concrete measures to achieve the desired outcome, which is strong, sustainable, and balanced growth?
Right. Well, very good. Well, we wish CIGI luck in its global economy program, and I look forward to having you back and talking in more detail about specific projects that CIGI will be working on going forward. And to our audience, please join us again on Inside the Issues, the CIGI Online podcast. Look for us at cgonline.org, on Facebook, on Twitter, and on YouTube.